Hi, and welcome back to the European VC, the go-to podcast for everything European VC. If you love the show, share it with your friends and join our newsletter at EU.VC. Today, we're happy to welcome Premysl, founder and managing partner of Presto Ventures, a Prague-based VC firm investing in early-stage and pre-Series A startups, built by exceptional founders from Central and Eastern Europe. If you enjoy our content, do support us by hitting the follow button, giving us a review, and following the European VC on LinkedIn.
Premysl, welcome to the European VC. Super nice to have you. How's everything today?
Hello, hey guys. Thanks for inviting me. Happy to be here.
So Premysl, we always start kind of with understanding who the guest is, and everyone can Google you, everyone can check out your name, can check out Presto, so that's not what we're interested in. Give us a quick rundown. Like, how the hell did you end up in this wonderful world of venture?
Funny story as always. My background is in mathematics, so I studied a very weird field in Prague, and then I actually wanted to change a bit, so I changed and I moved to Paris and did my master in mathematics in Paris, in the applied one. And then I discovered, obviously, that this is not my cup of tea for the whole career, so I changed a bit, and then I went into Air France and Amadeus in technological company, and then it was still a corporation, so I said, okay, so it's not my way. I need to start something on my own. So I started a business for a French investor in Czech Republic. Then I moved back to the Czech Republic from the French Riviera, which was at the time where Amadeus was a nice place, but quite boring for me. So I started this business and then went more into the kind of IT software and services. Then met startups and met the first Czech IT companies and Czech startup companies. And I was part of the big venture capital private equity firm, helping them with some of their projects. And 2015, beginning 2016, already had the motivation to start something on my own, and the main motivation to support the talented people, because I was used to be among all those mathematicians and all those bright minds, and at the same time I'm an active musician. So from the very beginning of my life, I was surrounded by those talented people. So the main motivation was, hey, I have some the hard skill knowledge in mathematics, and I have some kind of soft skill sales business experience from this my first business. So let's help those super talented people around me and the scientists and people in that space to build something valuable and to realize themselves into the startups. So this was my first motivation, and I basically did my first fund with a single LP. So it was a single LP backed venture fund that started in 2016, end 2016. And this was kind of proof of concept in the in the startup dictionary. We started just to do the sci tech and all those scientific commercialization, but then turned into a very standard VC. The most investment we did in 2018, 2019, 2020. So this is where we have built a portfolio of about 15 companies. Invested about 15 million euros in the first fund with this LP, and it turned out that even though it was a very start of my investment career, that I was lucky enough to have some very successful companies in the portfolio. And then based on the successes, together with friends that we've already been investing together, created a second fund and raised money from other LPs, mostly entrepreneurs, exited founders, family offices here in the region. This is the very brief story. So
yeah. So I have to start by derailing the conversation and saying you're the second Czech GP that I meet that is a past musician. And so I have this idea next time that EUVC is in Prague or around town. I'm a self-glorified failed musician as well. So okay. we'll do the worst concert in the world with GPs playing. So I think that'll be definitely a fun thing to do when we're drunk.
I play double bass actually, so I hope nice. this will help the band.
Beautiful. We have a guitar player as well.
And
fine.
And I'm a kick-ass dancer, so I can do sexy moves up on stage.
As long as you keep your clothes on, Andreas, I think everyone will enjoy that.
I'll keep it off because I'll start without it.
On a more serious note, Premysl, thank you for sharing that. And I think there's something incredibly interesting in your story. at least for me, which is, you starting with a thesis and evolving and changing over time. It's really easy to understand as an outsider, right? Well, we had this thesis, didn't really work out because there wasn't deal flow, or, there wasn't appetite from the investor side, whatever. But I can imagine that as an individual, right, as a young investor starting in the industry, right, that must have been a grueling experience and really hard to kind of take out the learning and get out on the other side. So I'd love to hear your story of how that process was for you.
No, is that like I had like some network on like among the scientists and universities, and was just like talking to people, trying to help some of the like innovation centers and those kind of stuff. And what I actually learned is that it's really hard to join this like scientific competence together with the entrepreneurial drive.
Yeah.
And there are like very, very few people that have both, and one without the another just doesn't work. And it's like a deal flow question. Like there is not enough projects to review. And I feel the venture is more and more. I think the venture is like a statistical game still. Like, so you need to see a lot of stuff, and you need to like do a lot of diversification and so on. So if you don't have deal flow, like just don't invest in that space, because you don't have enough choices and you don't have enough diversification to do. So that's why I like from the beginning, I was meeting like other founders as well, like not only the scientists, and more I felt that this will be the right way. And we gained a deal flow, and we gained deal flow not only from Czech Republic, but from other countries of the region. So more and more we were in the like very traditional like deal flow and screening startups and meeting like 100 startups a year, and now we are meeting 1,000 startups a year. And so this was the change, and basically the change of the thesis was just a deal flow case.
Something that I also had kind of here in top of mind of chatting with you about was, you said we started off with a single LP structure. It was also single GP, right? So it was single LP and single GP. Am I
Exactly.
right in saying that?
Yeah, exactly.
So that's super interesting, right? Because many of our listeners are probably thinking of doing that, or in the process of doing that, or in, kind of at the end of that process. So I'd love to hear some of your learnings there, but maybe starting with the LP side, right? Single LP. There's a lot of possible mistakes there that GPs can fall into when they're unaware of the ins and outs. Share with us your learnings.
You can never think that the resources are unlimited, basically, even if it's like a wealthy single LP family office. Like this is a one trap you can fall into, basically. That it's like never evergreen. Like it just doesn't exist. And then imagine a startup that has only one angel investor from the very beginning for a very long period of time. Like this just doesn't work for many reasons. So this is a very like and like a lot of even very like famous VCs started this way, like a single LP, because it was a like corporate VC, or because it was like a single family office putting some money aside for the venture. But like all the people I know in the space that started with a single LP, sooner or later raised their second fund and the real fund, like from other LPs as well. And I think it's a very healthy way. And I learned I learned a lot about the both sides, because if you can say that if you have one LP, you don't have this like raising experience, and you don't have the experience with the financial product for the LPs. But it's like, for me, it's the opposite way, because if you have a very like a strong and frequent relationship with the owner of the family office, then you learn perfectly how these people think, and how they used to do business, and how conservative they are, or how free they are to invest, and how they decide in a I would say in a crisis mode, and how they decide if there is something wrong with the company. And this is like for me, this was the like most crucial learning in my career, those like 5 years in this like single LP, single GP relationship. And I'm grateful for that. And it's like it's basically a very experienced angel investor that's actually it's giving you the experience of tens of years of doing business that you can then translate to the venture.
I've seen, some cases where, you have these single LP structures where the GPs are acting almost more as an advisor than the fund manager, right? In the sense that they don't have the final say at the end of the day. So they're sourcing deals, they're finding deals, they're DDing deals, but they don't have the say of investing the capital, right? And that is kind of a fucked up situation, because you're not really truly building a track record, right? As a fund manager.
Exactly. So I wasn't at that situation. But it's true that like if you are a partnership and you do investment, and at some point of time the investment doesn't work, and you need to decide whether you put more money or not, or I don't know, the investment doesn't hit a milestone, and there's like next money trigger, and the trigger is not met, so you don't send the money, and the company is basically either bankrupt or not. And this decision, it's very hard even in the partnership, because you say like there's this like marketing side of the stuff, because if you let the company go bankrupt, that it's like a reputation harm, obviously. And in the single LP, single GP, it's even harder because the LP has a very different interest than you have at the time. Like for him, it's like wasting more money, and for you, it's like keeping the company alive for a bit more time. So those situations were really hard. But once again, this was the situation I learned the most, and I learned the most about me, about how the LPs actually think, and I learned the most also about the founders, because in those like critical situation when you need to somehow take care about the relationship with both of them, and try to not do more harm than than needed. So this was hard, but it was like incredible learnings for the future, and for the things we are doing right now in the second fund, and we are like more GPs and many LPs.
Would you say that in your single LP structure, the fact that you had an angel was actually a blessing compared to having a corporate with other strategic agenda, or a very big kind
definitely.
of asset manager or whatever?
Exactly. And the very bright side of that was that this LP was like really interested into like meeting young people, entrepreneurs, supporting talented people. And he was basically like, he still is, because he's obviously a cornerstone investor in the second fund as well. And he's really like into all that, like meeting startups, enjoying the young atmosphere, the building atmosphere, the drive of the startup ecosystem, which is like very much different from the original business he came from, the industrial space. So like, and this was the blessing basically, compared to the some corporate VCs.
I have a question, which is, and you actually pointed to it there because you said many partners and many LPs. And you are many partners. When you look at your team, you don't have like two partners and then 5 staff, but all of you carry the partner role.
We are like 4 GPs, and the story for each of them is like quite diverse, but we know each other for many years, and one of them has been working for me probably from the early beginnings of the first fund, and the others are friends, and we've been investing together, and then just say, okay, so let's put our brains together and raise a fund together, and let's do it. And then we add one more partner, which I know from one of my like inherited portfolio company that I inherited from the family office, basically. So we are like 5 partners, and like each of us has like very different background, very different skill set, very different experience, which is helpful. Like we are still in the like the one GP founder relationship with our startups, but let's say that we open all the relationships to the founders, because we know that it's much better, even more for the large portfolios as we have, like, because we will have 40 companies in the second fund portfolio and probably 100 companies in the third fund. So we are trying to scale also the experience level of the GPs, and just to open the partnership to everyone, and open all our like close network to the community of the founders. So, and it helps a lot, basically, like this diversity in backgrounds and in views and in like characters helps a lot.
But at a firm building level, it's interesting that you opt for that many partners, but no principals, no associates, no analysts. Could you share me a bit the philosophy behind that?
Because like we all basically love meeting startups and digging deeper and doing all that like core VC work. So this is not that like we just don't want to do the screening. So let principals and associates and analysts like do it alone. Like we don't do it that way, but we feel that like we need to build this layer of people. So it's like it's exactly the same as in a startup. So I basically hired those best people that are partners in the fund, and then we are working together to bring in like more junior people and to learn them like how we want to do the thing, because like we feel that we try to build something for long term, and for long term you need very good people, and if you find someone who is already experienced in the VC space, this is a unicorn, because like the maturity of the CEE ecosystem is not so high. So there are not many people that are already experienced and that want to change, and then that are in Prague and then speak Czech and whatever we wanted to have. So we have this philosophy of spending time with junior people, hire the brightest ones, and let them learn with us and prepare. And we are right now preparing the team for the fund three. Obviously, the fund three will start investing in 24 or end 23 and this year. So we are preparing the juniors and already promote someone to associates, and then we will also have principals and such. So this is the philosophy.
Yeah.
This is once again about the like working with the talented people. Like this is the same thesis I have from the very beginning. Like let the most talented people thrive and let them learn. And this is what we do with startups, and this is what we do with also people we are hiring.
I'm curious to hear what have been because now you've run a full fund too, really without that extended team, right? What would you say have been the most inhibiting parts around that? And on the other hand, what have been the most giving parts? And what are you kind of thinking, okay, this is something I'm going to miss when we are starting to add more juniors to the team?
Like sooner or later, if you want to meet like 2,000 startups a year, you need to have enough hands to handle all of that stuff and all of that research and all of that market stuff. And if you want to be a good investor and have a good deal flow and do a lot of investments to diversify your portfolio, like you certainly need people that do that work. Once again, it's a startup basically. So we are trying to find the ways how this like a venture business, which is not scalable because it's a services business. So, but there are parts that can scale, and this part of like seeing startups and meeting startups at conferences and digging deeper into the startups and doing the market research, like this part can scale with the junior analysts that are really like passionate about startups and then that learn a lot and work hard and so on. So this is probably the only way where the venture capital firm can scale outside of adding more partners and obviously adding more money to the funds. But on the team side, more and more is the process of like how to screen startups, where to find them, what's the process of the selection, what's the funnel, and more you start basically building the process, and then it's much easier to add young people to the process. If you don't have the process, like you cannot have them, because it's very hard to put a very young unexperienced people into something that's not kind of more structured. But this is the work we've been doing last year, kind of build the process to enable us to bring more people onto the team and to prepare the company for the third fund and for the fund that might do like 5 investments a month. And if you want to do 5 investments a month, then you start to think, okay, what do we need to do to be able to do that? And one answer is like we should have a process. And second answer is like we should have a little bit more people in the process, because otherwise we still want to keep the filter very high. So we need to have like much more companies in the input to have still like those 5 companies a month as output, or 50 companies a year. This is the goal.
Yeah. And you just said something there that I have to dive into. Because you said you threw out the number 5 investments per month, and that might just have been an example, or is that actually what you're envisioning Presto to be able to? Because then, as you say on your website, and we need to touch on this, Presto Ventures, you say that the name speed is in, or this speed is in the name, and I'm curious what that means. Where the hell does that come from? Because Presto doesn't mean speed in my world. So where does that come from? And then also talk us through that 5 per month number when we're then talking about speed.
Yeah. The easier question, like Presto comes from like the Italian word, and I'm a musician, so like there is some like relationship between also there are like 5 lines as the musical lines, like in the logo. So there's like a musical heritage I have from the past, and Presto means like really fast in the musical terms. And so this is something that describes us quite well, and that's also the strategy we are actually starting. And so this is for the speed, and this is not a speed with like, okay, so let's spend the money as fast as possible. Like this is not the way how we think about it. Like the key value is still the responsibility, and then there is the speed, and then there is obviously like a human relationship we have with the founders and LPs and between each other. So on top of the responsibility of investing the money wisely and doing a good filter and so on, so the speed is still key, because like you need to act fast, and you need to actually prepare the team to be acting fast. And then we come to the 5 investments a month. During 22, we did actually 2 or 3 investments a month already. So in average. So doing a twice more or three times more, it's not that big deal because we now have the process of adding.
I realize now you're saying this that I don't even think I went shopping twice or three times last month.
And then like it all comes down to the deal flow, obviously, and we know that like last year we met something about like 1,885 founders or founding teams. We think that the number and it's like in 10 to 15 countries. So from the Prague to the east up until Baltics, down until Balkans, we are pretty strong in Georgia and this region as well. So like if you take all those countries and we are meeting like half of the market probably with the like 1,885 or probably even less than half of the market, there is definitely space to meet even more companies a year. And if you meet twice as many companies a year, like you can definitely do twice as many deals a year. If you have funds for that, and if you have a process and team that could basically proceed all that numbers.
And tell me just a bit about the portfolio model behind doing that many investments per month, because that also means, okay, let's multiply 2 to 3 with a 5-year investment period or 3 4 year investment period. How does your portfolio model look like?
Like the portfolio model is actually, we want to do like a 2-year investment period, so invest in 100 companies within 2 years, do the most diversification possible. So let's say that if we have a 100 million fund as a fund free, that the maximum amount of investment per company will be 2 or 3 million, not more. So the diversification is the key. This kind of like kept maximum ticket, or not maximum, but the total amount of money invested in one company will be limited. There will be LPs co-investment, like a lot of LP co-investments in the fund three, in the fund two as well, with the follow-on rounds. And what we feel is that this is the most adjusted strategy to the region, because if you look at the distribution of the exits and the evolution of the distributions of the exits, and this is very much mathematics and very much statistics, then you see that okay, so you can't really bet that you will hit many unicorns into your portfolios, because the ecosystem is a little bit behind the Western world, but then the efficiency is much better, and so on and so forth. Those are the benefits of the CE. But so in the fund model, if you have 100 companies, and if you expect some, I would say, Central Eastern European distribution of the exits, like the most successful strategy might be to diversify the most, invest into the companies that are good deals and that are like good founders and good potential to do at least 10 times. And then the probability of losing money is zero at this number of companies. And there is this like biggest probability of hitting like high returns. And also when there is a unicorn, the probability of hitting this unicorn, even in Central Eastern Europe, is quite high if you invest in a lot of companies. So this is the model in a nutshell. High numbers, like low maximum ticket, a lot of co-investments with LPs, and so on and so forth.
I have to ask this question before we move on to the quickfire, which is on the topic of diversification and your own model. And maybe it's important that you tie this into your stage and also your follow-on strategy. But how do you think about vintage diversification in what you were just saying? Because that is quite a lot of deals in just 2 years, right?
Like there is this discussion about, okay, so there have been 2 years of absolute outliers in terms of valuations and number of companies and deals and so on. And there are quite a lot of VCs saying, hey, like we invested at insane multiples, and right now like we are in hard times, and this is basically the outcome of the vintage diversification, because if you invest in a one portfolio like at high valuation and different space and so on, we are pretty untouched by that, because like the politics and the strategy always was, okay, let's not go with the trends of like insane multiples, and let's stay on the ground and look at the efficiency and look at the fundamentals. So I don't think this is like much more like, for example, between the first fund and second fund, like the valuations multiple are pretty much the same, even though the second fund mostly invested in the 2021, 22, so in the harder period of time. So if you have this hygiene of saying, hey, like to say no to very good deals that are just overpriced, then you can basically keep your strategy still the same. And we are in the B2B and marketplaces thesis. so B2B software, enterprise, and SaaS, and marketplaces. And we feel that there are like still a lot of companies like across the vintages. And obviously the market is like evolving in a way, but we are not saying, okay, so we did this kind of thesis in a fund two, so we won't do it in a fund three. Like, this is not what you do.
But did I understand you correctly, Premysl? You are working with 2-year investment cycles, really.
Like, this will be the for the first ticket implemented. So the portfolio, we call it like portfolio building. So the portfolio building cycle in fund two will be 2 years.
Yeah.
And the portfolio building in the fund three will be also 2 years, but we will deploy like twice or triple much capital.
That is aggressive, right? Many LPs
Yeah.
would say, I don't really like it.
That is what we call Presto.
Exactly. And this is the best time, because the startups are in a stress a bit because of the venture capital is no more like a free of charge. Venture capitalists are a bit stressed because they're invested at a high valuation. So all the industry is a bit stressed, as you know, obviously. And at the same time, we are in the area of Europe that is like the most capital efficient, and capital efficiency is the number one topic of the VC scene right now. So therefore, the CEE region will become probably the most interesting tech area of the world, or of Europe at least, at the end of this kind of crisis. So therefore, we feel that this is the time to be a bit more aggressive than the others, because we might invest in the companies that have the fundamentals, that have the capital efficiency, that are founded by talented founders from this region, and there are a lot of them. And then they have the drive, and they are all from the small post-communistic countries, and we know the spirit, we know the mindset, and we can help with it. Obviously, that's why we feel like this is the time to invest. Like, obviously, it should be good deals and good startups, but we don't feel any kind of pessimism of saying, hey, like, let's wait for times to be better. Like, I think this is the time to be more aggressive than before.
From a LP perspective, and you have this much money that you want to allocate to VC and this much then to that region, and then you want funds that give you diversification. You then normally would plot a fund into, say, that gives me exposure to this region for 4 or 5 years. But with you, it's only for 2 years. Do you see LPs, when they see that model, then do you have that conversation about them only allocating, for a 2-year period in the sense that you don't give them diversification to CEE for 5 years, right? You give them for 2 vintages. And as such, if they want to cover the region for 5 years, then they would have to do 2 funds from you, which means that, well,
Yeah,
then
exactly.
half the allocation, right?
I love. Premysl just had a little smile there on his face.
I think it's very smart from the LP point of view to diversify as well, and to diversify across the vintages as well. So this is how we work with the LPs. Like we are not hunting LPs for a fund, like we are hunting LPs for a lifetime, and saying, hey, like if you want to invest in us, let's test the cooperation with a smaller ticket in this fund, and then with the bigger tickets in the other funds. And if you are interested in startups, you should be allocating the money continuously, and not just in one fund and one vintage. But if you can allocate your money every 2 years and send us the money, or probably we will be like calling the money once a year or something like that, like half of the investment a year. So then you can allocate this much money a year into CE startups, and it will be split between the funds. So if David said like 4 or 5 years, like it will be 2 or 3 funds. So you split your allocation in 3, and this is like completely okay. This is the strategy, because like diversification is the key in the investment overall. So in general.
Premysl, we are running out of time, so we're now gonna jump into the quickfire round. And the quickfire round is that exciting part where I ask you quick answer questions. Are you ready?
Yes.
Deep breath. Yes. So first question: what areas, technologies, or sectors excite you the most that other people around you don't really feel that excited about?
I don't think there are some. We are still in a very beginnings of the of the GP careers, like even after 6 years. So
Yeah.
I'm always excited by many things, and I'm more excited by like new types of founders and founders from other countries and new businesses, and I'm always excited about like that we are pushed to learn something more about an obscure industry or
Yeah.
or sector we didn't know about, and we need to call our friends to say, hey, like, who knows anything about this one? So this is what I'm excited by, like, and not really verticals, like concrete verticals.
Second question is, what would be your top tips to other GPs out there emerging who are now fundraising for their funds?
So it will be 3 of them. The first one is kind of obvious: work hard.
Don't slack
like,
around, bitch.
yeah. No, definitely. Like, like, this is what we like. You need to be smart and fast, but it's not enough. Like, you need to spend time on that. And if you are fast enough and spend time, like, then you can like run a bit further than the others. So I think like work hard, spend time with the founders, spend time with the LPs, like do all the work that's needed. The second one will be, and especially for the emerging VCs, like always find ways how to innovate everything in the company. So how to help founders better, how to build a better product for the LPs, how to innovate your deal flow, how to do better processes so that the company is working in a more efficient way, and don't be stuck in the old way of doing the business because everyone is doing that way. Like I think the differentiation between VCs is very hard because this is still a services business, so it's hard to differentiate like two marketing agencies and two VC funds basically. And for the emerging VCs, even more because there is not this kind of history and long built reputation of the oldest funds. So for the emerging VCs, it needs to be some kind of like innovation differentiation in that way, and so we have like deal flow from different countries, and we build our portfolio in a different way, and we think about portfolio support in this way. So I think this will be the number 2, and the number 3 will be psychological resilience, work on stability, because this is just like a startup world. Like emerging VCs are still building their companies, and during the building there is obviously ups and downs, and the downs are very hard in the VC because the money are very long. You need to wait, you need to be patient, and then there are all that like and the disasters come first and the successes come seconds. So you at the beginning you just see the disasters, and then you start see the successes. So the resilience part and the emotional stability and the psychological stability is important, just as for other founders.
Third and final question, Premysl, is what would be your advice for investors, angels, VCs, whatever their profile is, looking into the CE, given that you are an advocate for the region?
Sales is everything. The region lacks a little bit of sales and marketing expertise. If you want to invest into the companies here, you need to be good at it. You need to help them with that. You need to help them with structuring their sales teams and structuring their pipelines and hiring their sales guys and so on. So I think sales will be the key for the next couple of years, because this is what the CE companies are still lacking compared to their counterparts in the West.
I really like that answer. Thanks a million, Premysl. This was so much fun. People have no idea how much we've been laughing because some of it have been edited out. But thanks a million, Premysl.
Yeah, that is very funny. Thank you for having me. Really good. Like, thanks. Looking forward to other encounters.
Thank you for listening to this episode of the European VC, the go-to podcast for everything European VC. If you love the show, share it with your friends and join our newsletter at EU.VC.